Good afternoon, everybody. Welcome to another episode of the Tower Wealth Advisory podcast series. Today, we're joined with Neeraj Pardeshi, the Regional Vice President of PPI Management. We talked to Neeraj about 3 months ago, back in June, with top tips for why business owners and high net worth individuals would use life insurance in their wealth management strategies. So we went over the first three topics back in June. If you guys are interested in looking at those, just go to towerwealth.com. You'll find them under our media postings. But today we're going to cover the next three topics that Neeraj has for us. So we broke it into two webinars because it is a fair bit to stomach. So hopefully we've got some attendees here in the audience that are ready to settle down and have a bite to eat for lunch because it's noon here in Alberta. So enjoy a bite to eat while you watch Neeraj do his presentation. Before we turn it over to Neeraj, a couple very quick housekeeping items. We just want to touch on the fact that if there are questions, we'll leave them to the end. We will leave time for that. We plan to wrap the webinar up within an hour. So at the end of the meeting or at the end of the presentation, we'll leave time for questions. Those can be asked down at the bottom on the Zoom features here. You'll be able to click on the question and answer tab and post a question. Dave and I will see those questions and we'll reiterate them to Neeraj so he can answer them. Other than that, I think we're good to move forward. So Neeraj, maybe I'll turn it over to you.
Awesome. Thank you, Tyler. And good afternoon, everyone. And thanks for joining us for part number 2 of the series, 6 reasons why you should be talking to your high net worth clients about life insurance. For agenda today, next slide, please. I just want to talk a little bit, just as a recap, that in the first part of this webinar series, we did talk about terminal tax liability. We did talk about retirement cash flow planning for your high net worth individuals, as well as one of the topics that comes up more often than not is about converting the taxable capital that is either trapped inside your corporate bank account or your personal bank account, converting that into a non-taxable capital assets. So those are the three that we discussed in the first part. Today, we are going to discuss the next three, which are, I would say, as common as the first three. The 6 that we talk about, these are the most common ones that we get. There are other planning needs and planning ideas out there that we can talk about on separate webinars. So for this part, we'll talk about buy-sell funding, we'll talk about a corporate insured annuity, and we'll talk about plan giving. And as you'll see that, next slide, please. What we're trying to do here is that when we talk about holistic planning, all of the 6 that we talk about, they fit into one of these molds that we talk about here. We're talking about cash flow planning, for example. It'll fit into investment planning. It'll fit partly into retirement planning as well as estate planning. Tax planning becomes a component of it. Same goes with, let's say, a buy-sell agreement. We're talking about succession planning, which would be part of your estate planning as well as tax planning. We are going to be talking about plan giving, which would be estate planning, estate preservation, insurance planning, as well as tax planning. So all of the 6 that we talk about, they are related in one way or other, or maybe some of them are related in more than one way with these 6 dimensions of holistic financial planning. Next slide, please. So just as a recap, and I'll go through this very quickly as opposed to what I did the last time. I mean, bottom line is that, we talk about this, that the need only arises if there's a problem. In this situation, or in this case, it is very important to understand the problem, which is that you have a business owner that has run his business successfully, has tons of revenue, obviously does not take all of that revenue out because there's going to be taxation. There's lots and lots of money that is sitting inside this corporation. And when I say the corporation, I typically mean the holding company. That's where you would stack up the retained earnings as such. All of this money that is sitting inside the corporation is obviously going to be part of some sort of a tax cycle as such. You have passive investment. Any growth that is happening on these retained earnings, that will be taxed at the passive investment tax rate. That is the highest in Canada for corporations. Next. Any money that the client or your business owner is trying to take out, either for lifestyle expenses or retirement income, anything like that, that is going to be taxed out at the very least at dividend tax rate. Whether it's eligible, ineligible, that is the secondary part. The bigger part is that it will be taxed. Since 2018, the government has brought in measures where they are talking about, corporations that are keeping lots and lots of retained earnings and earning passive income on these investment portfolios. If that was the case, up to a max of $150,000 of passive income that is generated inside a corporation, once it hits that threshold, the business loses its small business deduction limit. Now, some might say, oh, I've got a large rate corporation, and what is the effect of that? In Alberta, the effect would be roughly about $70,000. But my point is that, by bits and pieces, you can see that the retained earnings that are being retained inside this holding company are being taken out by X amount of tax, Y amount of tax, one tax here, one tax there, etc. So that's while the client is alive. And then when the individual passes away, obviously there is going to be another layer of taxation. There is going to be capital gains taxation. If you don't do planning, there'll be taxation based on the money that needs to be extracted out of this corporation. There'll be another dividend taxation. There are going to be probate fees, other costs, liquidation, fire sale, etc. Bottom line is that even though the good part is that there is lots and lots of retained earnings, but it brings a set of problems with it. Next slide, please. And the same goes for, we saw that in a corporate situation. The same is applicable for an investment portfolio, that either if you have it inside a corporation or if you have it in your personal name outside of a corporation, everything will still be subject to taxation at one time or another. Next slide, please. So we've looked at the good, we've looked at the problem, we've looked at the good problem as a combined thing. Where does life insurance, why are we talking about life insurance? Life insurance sits in a unique position in tax laws to help alleviate, and may not be to the fullest extent, but I'm talking about trying to bring in efficiencies here, may be able to alleviate the problem that you have in the most efficient manner. Bottom line is, if you still have those problems, what we could do is we could use the retained earnings to buy a life insurance policy that is owned by the corporation, where the growth inside the life insurance policy is tax deferred. If that's the case, we've taken care of two tax problems, the passive income tax growth, as well as the reduction of the small business deduction because of the passive income growth beyond a certain threshold. We've taken care of those two problems as such. The cash values inside the life insurance policy, they can be used as collateral, and they can be used for either lifestyle expenses, retirement income, or they can be used for other business expenses, i.e. investment inside a business as such. Or the client can actually take these and create an investment portfolio outside. So that is bringing efficiency into that part of the taxation. Next slide, please. And on top of that, the client is going to pass away at a certain point in time. There will be another layer, a third layer of taxation when this individual passes away. Life insurance has something called as a capital dividend account credit. On the life insurance policy, we see that the capital dividend account credit grows as the client or as the policy ages. This CDA can be used to take out tax-free capital dividends to pay out terminal tax liabilities or any other things. In this situation, when we are talking about buy-sell funding, for example, the CDA can be used for the purpose of buy-sell funding. The corporate insured annuity example that we are going to see, CDA will be used in making sure that maximum amount of dollars are able to extract out of the estate, out of the corporation into the hands of estate as such. Next slide, please. So with that background, where we look at the problem and we try and understand where insurance fits in, let's look at the next three reasons. Next slide, please. So buy-sell planning. So this is reason number 4 in the series. The purpose of a buy-sell, and I mean from the purpose of drafting an agreement or setting up an agreement between partners, is that you're trying to protect the value of the business. When we say that protecting the value of the business, this is not just about protecting the value of the business for the survivor or for the deceased estate. It is about making sure that there is a succession plan in place also. A buy-sell agreement is designed to provide an orderly change of ownership. we talk about estate planning as the art of dying neatly. I say that, buy-sell planning is the art of transitioning the business neatly. A properly drafted buy-sell agreement, obviously you have all the details, all the mechanics that go in it in terms of what the partners want to see happen. And once it is drafted, signed and sealed, it becomes the blueprint for how to manage this when one of them passes away. Next slide, please. So more often than not, we see that there are clients that have actually done some sort of planning in with buy-sell, where they have actually drafted the buy-sell agreement. One of the things that we see that is lacking, I would not say in all of them, but definitely a lot of them, is the fact that yes, you do have the buy-sell agreement drafted and signed, but it does not have a funding mechanism, which leaves the funding part to the survivor, the surviving shareholder, and how they can manage while the deceased estate or the deceased family is actually wanting their portion or their share of the business as such. With having said that, that is where we find that the most cost-effective method, and I mean, I want to make sure that I bring this out too, that we understand that this is not the only way to do things. However, here we are always talking about efficiency. We are looking at what is going to be the most cost-effective, what is going to be the most efficient solution, not only for the deceased party, but for the survivor also. And by and large, if the buy-sell agreement is funded with the proceeds of life insurance, that provides the most cost-effective way of funding the requirement of the buy-sell. Next slide, please. So simplistically put, what you're doing is, if you look at this simple example, if this was a corporation owned by two shareholders who own it 50-50, the corporation is going to purchase life insurance policies on each of these shareholders for their respective shares. So if this was worth $1 million, then the business was valued at $1 million, then $500,000 on one shareholder and $500,000 on the other shareholder. When one of them passes away, $500,000 gets paid out, which can be used to buy shares of the deceased shareholder. Next slide, please. So we talk about life insurance, we talk about funding, etc. I mean, it does have unique advantages. I mean, obviously, the biggest advantage is the fact that the death benefit paid out to the corporation is always going to be tax-free. With that, and with the capital dividend account credit that is created because of the life insurance policy, it becomes tax effective no matter what the buyout structure is. One of the unique features of the capital dividend account credit with respect to life insurance policies is that, yes, you can create or you can have a CDA credit to inside the corporation once you dispose of capital gains type of investments, but that will be always limited to 50%. Life insurance policies, the CDA credit actually increases. Depending upon the ages, the CDA credit at death could be as or equal to or as close as possible to the actual death benefit that is being paid out. What I mean by that is, let's say if you start off with $1 million life insurance policy, which grows to a $5 million death benefit at some point in time, the CDA, if it starts off at, let's say, $900,000 at some point in time, it might actually, by the time the client passes away, it might actually be a $5 million capital dividend account credit, which means that the surviving shareholder can extract the entire $5 million of death benefit on a tax-free basis. And that's what we mean by tax effective. Obviously, depending upon the type of product you choose, the business is not, the death benefit increases. And why is it relevant is because everybody's trying to grow their business. So the fair market value, if it was 1 million today, maybe in 10 years time, it might be 2.5 or 3 million. You may have bought life insurance policy that was started off with $1 million. However, depending upon how it is being funded, chances are that you could actually keep pace with the growth in the business so that you are, you may be in line with whatever the death benefit, or whatever the fair market value of the business is at that time, or you may be a little bit short, not drastically. So that is where the increasing death benefit accounts for the increasing fair market value of the company also. Next slide, please. I mean, there are certain consideration also. Premiums are paid from corporate cash flow, not tax deductible. I mean, there are ways to deduct the premiums, but that is a separate conversation. But in a normal scenario, the premiums are not tax deductible. They are paid from retained earnings after tax dollars. Medical and financial underwriting is required for each insured business owner. And depending upon the ages and the health status, premiums may differ from one shareholder to another. However, the equalizing factor is that it is the corporation that is paying for these premiums. It is not the individual, like one individual paying for the other as such. Next slide, please. As I mentioned earlier, I mean, this is not, life insurance is not the only way. Yes, you could decide that, well, we'll just take care of it from this future business cash flow. We are confident that we will, there will be so much retained earning in the corporation that if one of us were to pass away, then there will definitely be funds available. Normally, we see that that is not the case because the business uses retained earnings as and when it needs, either for growth, expansion, downturn, anything else. That's part number one. Part number two is the consideration that there is no guarantee that future profits can actually support the buyout. Ownership of shares may not pass immediately to the surviving business owner. That is also a consideration, mainly because if you're trying to spread it over, let's say, over a period of 10 years, just because you don't have the required cash flow, the value of the shares is now, let's say, 2.5 million based on a $5 million valuation. However, the retained earnings are only 500,000. So you do an agreement with the survivor's estate or the survivor's family saying, oh, how about we do this buyout over the next 10 years? Which means that the surviving shareholder is not going to own these shares. The family or one or some of the family members may actually own these shares, and they may want involvement in the business. So all of these things could also bring a different set of turmoil into the business, not just with the fact that you've lost your business partner who was part of the business and sharing the responsibilities as such. Next slide, please. Another option is, well, we don't want, let's say, the estate or the family members or the deceased, they say, no, we want the money right now. Or you, as a surviving shareholder, wants to own or have ownership of these shares right now because you don't like working with, X family member or Y family member of the deceased as such. If that's the case, then the other option is trying to get a loan as such. So the business will take out a loan and they will be able to buy the deceased shareholders' business interest. However, I mean, we all know banks, we all know lenders, they will do full financial underwriting. The business may not qualify. If you take on too much debt, obviously there might be limitations on how much debt you can take on, but if you take on too much debt, then the value of the business obviously gets diluted. You have to make interest payments. And the loan, and just by the fact that now you have, instead of, let's say, $1 million of loan, now you may have $3 million of loan, that will constrain the ability of the business to borrow if there are other opportunities that the business finds out that, oh, I can expand into this, or I can buy this supplier, that supplier. Either it is vertical integration or horizontal as such. Next slide, please. So with that background, let's look at an actual case. All of the cases that I talk about here are actual cases that we worked on. So these are actual clients. We've scrubbed the information just to the bare bones. 47-year-old partner of this business who owns 45% of the shares. Fair market value of the business at that time was roughly about $10 million with a growth rate of approximately 3% year on year. If that was the case, and if we said, oh, you know what, this gentleman needs to be insured, so funds required for buying out, if this gentleman were to pass away, it would be $4.5 million. Life insurance cost for his age at that time would have been $297,000 annually. This is not the cheapest or this is not the lowest cost, but we'll get to the reason for choosing this type of product on the next slide as such. But let's look at the options. We talked about three options. There's life insurance, there is future business cash flow, and there's the loan. if this individual died tomorrow after the life insurance policy was put into place and they died tomorrow, life insurance payout would have been $297,000. That would cost, and the premium payout would have been $297,000, and the death benefit would have been $4.5 million to buy out his share. Net present value per dollar of benefit is 7 cents. If you do that from a future business cash flow perspective, to be able to generate $4.5 million, to be able to come up with $4.5 million over a period of time, over a period of 10 years at 4% interest rate, would cost them $5.2 million, which is roughly about 100 cents, as in dollar for a dollar as such. The loan, if they take a loan over a period of 5 years, they agree that, you know what, we'll take a loan, we'll buy this share immediately, but the bank says that, or you say to the bank that I'm going to pay this off in 5 years. At 5%, it is going to cost roughly about $5 million to pay or to buy out this $4.5 million of the deceased shares, which is roughly about 102 cents for every dollar that has been used. So you can see that, you know, if this gentleman were to pass away, let's say tomorrow or next month or within the year itself, life insurance cost is going to be roughly 7 cents for each dollar of benefit, as opposed to 100 cents or 102 cents for each dollar of benefit that the survivor needs. Next slide, please. I mean, that was an extreme example that, you know, the shareholder dies the next day. Let's look at it from the perspective that if the shareholder dies 10 years from now, so he's 57 years now, he passes away. But by the way, I mean, we saw that there was a growth rate of about 3% on this business. So the business has grown to about $6.6 million, or the value of this gentleman's shares has grown to $6.6 million. Out of pocket, from a life insurance perspective, is $2.9 million, 297 times 10. That is what has been paid out. The death benefit has grown to $8.5 million, which means that if this individual were to pass away after 10 years, the corporation would receive $8.5 million. The surviving shareholder will use $6.6 million of that $8.5 million to buy shares from the estate, and there would be about $1.9 million left over inside the corporation. The net present value of this $2.9 million over a period of 10 years is 2.6, which means that for every dollar of benefit that is received, it is costing them 31 cents. If you look at future business cash flow, $6.6 million, the same logic, buyout, expense of funding the buyout over a period of 10 years at 4%, it is going to cost them 68 cents if they do use the future business cash flow. Or if they take the loan at the same 5-year payout, 5% loan interest rate, it is going to cost them 69 cents. So even if this gentleman were to pass away after 10 years, or if the funding was required after 10 years' time, we see that life insurance is still less than half of what would be required on the other two options. And this scenario is the same if this gentleman were to pass away after 20 years as such, which would be 67 years. We would still see that the life insurance net present value cost to every dollar of death benefit still hovers around the 30 cents per dollar of benefit, as opposed to the 65 cents of future business cash flow or loan. Next slide, please. So that was all about buy-sell planning. I mean, and the reason I spent a little bit more time on that was because buy-sell planning plays a bigger role in the estate planning conversation, because as I mentioned, it is not just about buying the shares. It is about estate planning. It is about succession planning. It is about estate preservation as such. Let's look at the other option, corporate insured annuity. Corporate insured annuity, I mean, it can fit into, again, multiple compartments of holistic planning. It can definitely fit into some sort of a retirement income planning. It can fit into estate preservation, estate enhancement planning. Most of the times what we see is that the corporate insured annuity clients do or get into to make sure that they are enhancing the value of their estate. We saw earlier when we looked at the problem slide where anything and everything, even if the client passes away, whatever is the value of the fair market value of that particular business, obviously there is going to be taxation. Capital gains, dividend tax, with planning, without planning, you could have both taxation, or at the very least, you would have one part of the taxation. These people, they do not need the money. The funds that are accumulated inside the court, they already have other non-registered assets outside which can help them with either whatever that they need for their lifestyle expenses or other expenses that they are looking forward to for the remainder of their life. Most of them, I would say, I mean, yeah, it's a corporate insured annuity, so you need to be a shareholder of a corporation that has surplus retained capital, typically over 60 years of age. And the reason I say that is because we want to make sure that there is some sort of balance between what you're trying to, or what you get as income from the annuity, as well as what are the charges that need to be paid for buying the insurance as such. Next slide, please. So this just gives a little bit of detail on how does the corporate insured annuity work. I mean, the corporation is going to buy two entities. One is going to be an annuity on the life of the shareholder, and then is going to buy a life insurance policy on the life of this particular shareholder. The income from the annuity can be used either for the purpose of generating some sort of income supplement for the shareholder, or, as you can see, that it can be used to fund the life insurance policy as such. Bottom line is, all the money that is sitting inside the corporation, which would have been taxable in any way, shape, or form, either while the shareholder is alive or when the shareholder dies, we can actually help move it in such a way that we are bringing in more efficiency. Instead of having 40% or 45% go out to taxation, maybe there's only 10% that leaves, or maybe there is a component of estate enhancement over and above the typical planning that would have been done. Next slide, please. So let's look at an example. 66-year-old gentleman had $1 million of cash sitting in one of his dormant corporations. As I mentioned, these are clients who have other cash or other investment assets, non-registered, registered, etc., that they can use for their lifestyle or their livelihood. So this gentleman, this was a dormant corporation. There was nothing. It was basically a holdco. There was $1 million of cash sitting inside this. And this gentleman was looking at efficiency in terms of extracting this cash or passing this cash on to his estate or to his beneficiaries as such. The proposal that we went with was a 60-year-old, he buys, or the corporation buys, an annuity on the life of this gentleman, which will provide with an after-tax annuity payment. I mean, you can see it starts at 62,000, 47,000, 47, et cetera, et cetera. So these are all after-tax numbers. The pre-tax numbers are pretty straightforward. However, because this is not a prescribed annuity, this will be a non-prescribed annuity. That's why there is a difference in taxation as such, which is why your after-tax annuity payments look different. So then we said, okay, what if, so you have $1 million of capital in there. We use that to buy an annuity. From that payment, how about we buy a life insurance policy worth $1 million? So we are replacing the capital that was sitting inside this corporation in a taxable environment, or could be in a taxable environment at some point in time, into some sort of a tax sheltered, tax deferred environment as such. So for $1 million of life insurance, the deposit required is $33,000. So $62,000, $33,000 goes towards insurance, $47,000 is after tax left over in the corporation, $33,000 goes towards insurance, etc. So this is the net every year that is remaining inside the corporation, where it shows net cash flow to the corporation. So you can see that it's 28,000, 14,000, 14,000, etc. RDTO's refund, blah, 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 all of those things, the tax stuff. The total dividend that can actually be paid out to the individual over and above the life insurance premiums is roughly about 20 some odd thousand. If that was paid, the shareholder, after dividend taxes are paid, would end up roughly about $13,000-14,000 of actual cash in his pocket after tax. So what we've done is we've taken this $1 million of cash, we've converted into $1 million of annuity. From the payment, we've bought $1 million of life insurance policy, and on top of that, there's about $13,000-14,000 of payment going to this individual. If you think that is all, I mean, the biggest benefit out here is the fact that by moving this $1 million of cash from this dormant corporation into an insured annuity, we have reduced the fair market value of the corporation to zero. An insured annuity does not have any fair market value. An annuity does not have any fair market value, because the moment an annuity is bought, there is literally no cash. So the fair market value of this particular corporation is zero. Now, for those that are technically inclined, $1 million worth of fair market value at the very least would have been $240,000 of taxation if the gentleman were to pass away. Next slide, please. So that's what we're talking about here. So I've laid out three different options. As I showed you one option in the previous slide. We're talking about buying $1 million out of insured annuity as such. But bottom line is, if they don't do anything, if there's $1 million of cash sitting inside the corporation, which is basically the fair market value of the corporation, and let's assume that the ACV of the shares is zero, and we're doing this just for ease of calculation. I understand that if there's cash, I mean the ACV would not be zero. However, just for ease of calculation, if it was zero and $1 million of capital gain, if you do pipeline planning, net to the beneficiaries would be $760,000. We are eliminating double taxation. So $760,000 in the hands of the beneficiary. Instead of that, we showed option number 2, which is the corporate insured annuity. What we said was we took the $1 million of cash, we moved it into an annuity with $1 million of life insurance policy. When this gentleman passes away, there'll be $1 million of death benefit that gets paid out to the corporation. The capital dividend account credit is $1 million, which means that the corporation can provide a tax-free capital dividend to the estate or to the surviving shareholders of $1 million. So we've taken this $1 million and we've put $1 million in the hands of the beneficiaries. But that's not all. Remember, there was excess cash that was sitting, or there was excess income that was remaining inside the corporation, which was being provided to the shareholder. That's about roughly $13,000 or $14,000 annually. That is approximately $250,000 till the time this gentleman passes away. We've taken the $1 million of cash that was sitting inside the corporation, and instead of it being a total benefit of $760,000, you can see that this benefit is roughly about $1.25 million. $250,000 for the shareholder and about $1 million for the beneficiary. That's one way of doing it. The other way of doing it would have been where we would have taken the entire proceeds, after-tax proceeds that were left inside the corporation on an annual basis, and we would have used that to buy a life insurance policy. If that was the case, as an example, that would have bought $1.5 million of life insurance policy, $1.5 million of CDA credit, and if the gentleman did not need this $250,000 of income in their pocket, they could potentially be able to pass on $1.5 million to the beneficiaries. Estate enhancement, part of estate planning. We've taken the $1 million of cash that was sitting in there, which would have been $760,000 in the hands of the beneficiaries, and we've provided either $1.25 or $1.5 million of benefit going to either the shareholder or the shareholder and his beneficiaries. So that is your corporate insured annuity concept. Next slide, please. The last reason on this part of the presentation is planned giving. Planned giving, we've seen in the last, I would say, 5 to 7 years, has come up on the forefront of financial planning. We are seeing a lot of clients that are looking at charitable gifting options. We've been seeing or hearing about, I mean, many of you would have heard about the Bill Gates of the world and all the other billionaires, multi-billionaires that are talking about donating parts of their estate, etc. I think that has generated, or that has given, fanned the fire of charitable gifting to a bigger level, and we are seeing more and more clients actually looking at this as part of estate planning as such. Bottom line is, people are realizing that all of the assets that you've built up throughout your life with your blood, sweat, tears, etc., they can be divided, or they will be divided into these three into these three buckets. I mean, obviously, it could go to your beneficiaries. CRA is going to take, I mean, there is nothing, I mean, that is the obvious part. CRA is going to take a cut of any growth or anything that is tax related, either one way or the other on this. The third option that you have is obviously making sure that you are giving back to the society. So you have these three options available on the assets that you've built up throughout your lifetime. And I'm talking, when I say assets that you've built up, I'm talking about the assets that you won't be able to consume during your lifetime. If that is the case, you have the option of picking two. And what I mean by picking two is that we are not talking about circumnavigating or saying that, oh, we'll do some sort of planning which will make sure that CRA does not get any money as such. No, this is about efficiency. This is about the fact that, because I've had clients that say, well, we understand that we need to pay taxes. Yes, of course, we understand that too. However, is there a better way? Is there a way that we can actually help either reduce the tax liability or pay for it in a better way as such? Next slide, please. So what does it do? It obviously helps support your favorite charitable organization in a more significant way. And I talked about, giving back to the society. The tax dollars that we are giving to the government, they are being used within society as such. I mean, it is for whatever reason. I mean, it is not just about infrastructure. It is about providing support mechanisms to the society also. Charitable organizations, they also play a big or huge role in that part. So whatever that you're doing in terms of planned giving will support your charitable organization to be able to provide or give back to the society. And obviously, because of the tax credit that are involved when you're doing charitable donations, I mean, it does help with protecting the value of your estate, either estate preservation or estate enhancement also, depending upon the way that you're choosing. Now, I'm going to talk about just the three most common choices. There are other options. There are other significant or complex options that we deal with also, in which case you're talking about estate enhancement and not just estate preservation as such. But I mean, the choices are very clear. Either cash donations, which a lot of people or most people do on an ongoing basis, on a regular basis. They'll just write a check here or donate X amount of dollars to a charity and take the receipt, and that is what they will use as tax credit. The other option is basically where you would buy a life insurance policy and make the charity as the owner. Or you would buy an insurance policy and you would just provide the death benefit of that insurance policy to the charity when you pass away. Each of these has its unique benefits, pros and cons. I mean, I would not say con as such, but it has its distinctions in terms of what it does for you as the individual and what it does for the charity in terms of the money that is received. Next slide, please. So here's an example that we talk about. If you're looking at somebody that is roughly about 50 years of age, and if they have options, if they could either give cash or they could buy an insurance policy, the three options that we talked about earlier, or they can buy an insurance policy and make the charity or transfer ownership to the charity, or buy an insurance policy and have the death benefit go to the charity. I mean, this is how it is laid out. From a cash donation or the charity owns the policy, it is the same. Cash is cash. You're basically just putting money in, and so the premiums are basically cash, and you'll be getting a tax receipt for that if that's the case, and if that's exactly the same amount of cash donations that you're doing. So these two would be same. In this example, the actual tax credits are roughly $830,000 to the individual and the charity. In the first instance, if you're just doing cash with the same amount of premium that is going in, the benefit to the charity is $1 million of actual dollars as such. However, if you use that same money, so instead of giving it out as cash to the charity, and you use that money to buy a life insurance policy and then transfer ownership of the life insurance policy to the charity, while you are still paying the premiums for that particular life insurance policy on your life, you would get the same tax credit. However, the charity is going to get $2.3 million. The charity could potentially get $2.3 million of death benefit when you pass away at age 83, let's say, if that was your life expectancy. The third option is that what you do is you buy the same insurance policy. However, you're not transferring ownership. You're not doing any charitable tax receipts while you're alive or during a lifetime. But what you're doing is you say that the beneficiary of this life insurance policy or the death benefit would be the charity. So in that situation, what happens is when you pass away at age 83, the charity receives $2.3 million as benefit, and your estate receives 1.2 or $1.25 million as tax credits in terms of actual dollars. The distinction between these three options is the fact that the top two, the first one is obviously you will get the benefit in your lifetime. The charity gets the benefit in their lifetime, in your lifetime. The second option is where you're getting the benefit of the tax credits during your lifetime, and the charity is getting the benefit once you pass away. So option number one, both are getting the benefit during your lifetime. Option number two, you get the benefit during your lifetime and the charity gets the benefit when you pass away. Option number three is both get the benefit when you pass away. And obviously that is reflected in the benefit that you receive or your estate receives once you pass away. So depending upon what is required for your estate in terms of the planning that needs to be done, if it is something that you need that, oh, I need these tax credits on an ongoing basis, then it could be option number one or option number two. I don't need these tax credits on an ongoing basis. However, I need to make sure that there is a bigger tax credit available for XYZ tax liability that may arise when I pass away. Option number three. I could, instead of doing $1 million of benefit to the charity, I want the charity to have more. Maybe $2.3 million is a good enough number. Obviously, option number two or option number three. So that is planned giving, or that is how life insurance could actually enhance the value that you are providing to the charity, as well as the value that you are getting in terms of your estate planning needs, be it while you're during a lifetime or once you pass away. Next slide, please. So those are the next three or 4, 5, 6 that I wanted to cover in this presentation. But just as a recap, I mean, we talk about the 6 reasons. And as I said, I mean, I want to make sure that, these 6 reasons, they are not in isolation with any and every of these financial planning bullets that we see on the left-hand side. Every one of these fits with more than one aspect of holistic financial planning. That's the part that I want to keep on repeating. Each one of them is not individualistic. When we are looking at financial planning, we are looking at more than one of these. It's not like somebody just talks about terminal tax liability and that's about it. If you're talking about terminal tax liability, usually there is a discussion about planned giving. If we talk about buy-sell funding, there is usually a talk about tax liability. There is usually a discussion about converting taxable capital to non-taxable capital. When you're talking about retirement cash flow planning, we are talking about either the annuities, or we are talking about converting taxable capital to non-taxable capital. We are talking about terminal tax liability in those situations also. I mean, some might say, oh, retirement cash flow planning, why would you talk about? But those are the things that are part and parcel of that particular conversation also. I mean, we started with the tax problem as such. This is not about fixing the tax problem. We know that the tax problem is always going to be there. What we are trying to accomplish here is there a better way of mitigating, alleviating, or reducing this particular tax problem as such? If there are 4 levels of taxation, if we can bring efficiency into 1, 2, or 3 levels, I would say that is really good financial planning. as opposed to just trying to, oh, I can't do anything, or taxes are a given, and that's about it. Next slide, please. As I was saying, I mean, these are not the only things. When we are talking about financial planning, there are other things also that come up into place. The 6 that I talked about, those are the most common ones. Those are the ones that are discussed more often than not. However, depending upon the client situation, I mean, there would be reasons for living buyout planning. We talk about buy-sell planning. The example that I showed was on death, but there could be a need to buy somebody out while they're alive. So that's where you would have buy-sell in terms of a living buyout. We talk about estate equalization. We're talking about estate planning. There might be, members of a family that may be coming into the business and some may not, for whatever reasons. I mean, there might be a need for equalizing that estate in some way, shape, or form. We talk about succession planning. There are key employees, there are key people in a business. If they were to leave or if they were to pass away, there would be significant impact to the business. I mean, that's where we talk about key person planning. We talk about employee retention planning in terms of using how can you use life insurance to make sure that you're able to sweeten the deal for the employee to stay over and above what you might be giving them as compensation or incentives or bonus packages or a healthcare spending account, etc. So there are more than the 6 reasons that we talk about that are part and parcel of holistic financial planning as such. Just wanted to make sure that we touched a little bit on those and to let you know that the 6 are not the only reasons. Next slide, please. That concludes the second part of the presentation, and I will flip it over to Dave and Tyler to see if there are any questions.
Right on, Neeraj. Thank you very much for sharing that with us. It almost sounds like you're teeing yourself up for part 3. We didn't have one planned, but those reasons that you touched on right at the very end are compelling as well. Yeah, so thank you very much. What we'd like to do now, I guess, is just open it for any questions. If people have any questions, as I mentioned earlier, you can certainly submit a question in the bottom of the Zoom media program there. It's got a question and answer tab that you can click on and submit a question. We'll see them here and then we can relay them to Neeraj. But before we jump into questions, if there are any from our audience, I do have, I guess, a couple of questions. So I'll maybe start it off, Neeraj. And my first one was just in regards to the buy-sell funding. I know some of the comments that we get from business owners when we're presenting this stuff to them, in your example, I think you're around $297,000 a year in premium requirement. For a business that's successful and is growing, that premium requirement is a reasonable expense and they can certainly get their heads around it. But sometimes the comment becomes, well, how long am I going to have to pay this for? Like, I can foresee the next 5 to 10 years I can do that. But, is there ways for them to cut off their premium at some point and still maintain coverage? Or, what solutions do you have for guys there?
Right. So that's a very valid question, and you're absolutely right. We do get that question also. So the example that I showed, the reason that it was $297,000 and not $97,000 was because there is a bit of overfunding built into it. What that does is it allows the insurance policy to be pre-funded in a shorter period of time, as opposed to having to keep on funding it for life or whatever duration that you need it for. The $297,000 is actually helping the policy go on a premium offset after the 10th year. What I mean by that is that chances are, after that point in time, the cash values of the policy itself support the growth of the policy as such. So to your question or to your comment, in that scenario, the premium requirement was for only 10 years. After that, the policy was illustrated as self-sustaining. Irrespective of whether the client died after 10 years or whether the client died after 25 years, the policy would have self-sustained and keep on growing at similar pace or maybe at a different pace. But the premium required, or the client would not have to, or the corporation would not have to make another premium payment in that situation.
Yeah, that's perfect. I mean, I do like that those policies also have the ability to build in growth into them so that you can kind of pace. I mean, they're not going to, go lock and step with the growth of your company, but at least they can reflect growth and say, okay, well, let's grow actually the death benefit because we know our company's growing and we only need X amount of buy-sell funding right now, but we can see that in 5 or 10 years time, we're going to need more. Let's get that underwriting done and the product set up at the start versus trying to do it in the future. So yeah, pretty compelling, I guess, as a way to fund your buy-sell agreement. It's almost a no-brainer to look at life insurance if the shareholders are healthy and able to qualify for it.
Right.
Well, it's like everything. I mean, when the right time to do it, when you're young, when you're new shareholders, you don't have the cash flow, you don't see the future as brightly, for sure. You're not growing as fast as you might. And when you finally get there, realize you should be taking care of some of these things, you're non-insurable. Or you have other problems that arise to take care of it. Maybe you didn't even write a USA to begin with. So things get complicated.
Yeah, absolutely. I mean, if I were to assign priority, I would say priority number one is to get the USA. So at least you have an agreement. Funding definitely is a priority, but I would say, having the funding in place without an agreement is basically, like the other way around. I would say get the USA first. That should be the topmost priority. And the second most priority should be make sure that there is funding arrangement.
We do have one question here on the buy-sell. I mean, it was answered in our slides, so I'm just kind of looking at it more from a summation point of view. But, the different ways to fund a buy-sell. Obviously, we talked as insurance is the most effective way. You mentioned you have to go get a loan, which you might be able to get, you might not be able to get, or you have to make a deal with whoever you're paying out their estate or their heirs. You have to find a way to pay them out over time. Can you think of anything else other than the three, or that's pretty much it?
Well, yeah, I mean, you could start off like an investment fund somewhere, but that is basically taking care from the future business cash flow as such. That's the reason I did not separate it out. I just put it as future business cash flow, because if you're starting a fund somewhere, it is coming out from the retained earnings that the corporation or revenues of the corporation every single year. So it is part and parcel of the future business cash flow. But I mean, the number of times that I've sat in meetings where one of the people or one of the shareholders have passed away, and there is like a big push either from the deceased family or the surviving shareholder itself. I mean, I remember this case where I went and talked to this gentleman, farmer, a little bit outside of High River. His brother had passed away in a grain silo accident, and the wife of this deceased brother, she was adamant that she wanted her money in like 15 days. I was like, okay, how do you right? And yeah, he was scrambling because they did have a buy-sell in place. However, it was not funded fully. So to your point about what you talked about, when you start off young, etc., that is exactly what they had done. They had bought a term type of policy, which I would say is still good. Something is better than nothing. However, in this case, the deceased shareholder's share was roughly about $7 million that they had agreed upon. The life insurance policy was only, I think, about 2.4 or $2.5 million as such.
Yep.
And this spouse was asking for the money in 15 days.
Yeah.
So,
and even trying to set aside some money to buy your partner out if something is to happen. Well, like you said, if you set it aside inside of a corporate investment account, well, your partner is entitled to half of that value. I mean,
exactly
of the corporation, so you have to pull it out of the corporation, set up your own investment pool in your own name after tax money. It's just the most inefficient way.
Absolutely, yeah. Either inside the corporation or outside the corporation, it is highly inefficient.
Yep. Okay, well, that takes care of kind of the different ways on the buy sell. Other than bringing a new shareholder in to buy the other one out, I mean, that's pretty far-fetched and hard to do in a short-term notice.
Yep. Exactly. And like I said, I mean, that's the reason I gave you that extreme example of 15 days, because that, I mean, I had never heard about it. I mean, I've seen cases where, they agree upon, let's do it over a period of a year or 2 years or 5 years and such. But this was the extreme one. It was 15 days notice.
What are they going to do at 15 days anyways? Like come seize property? Pretty hard to do.
Well, I mean, that talks more to the family dynamic.
Yeah.
And I mean, I can understand why this gentleman did not want the spouse to be partners or whatever, right? I mean, I can very well understand, but that speaks more to the family dynamic.
Yeah, we have some of those situations with some farmers as well. Lots of property, huge value, brothers. You know, it's very difficult to see what happens after one passes away. I mean, if your family gets along well, that's okay. But, you know, as time passes, after someone passes away, it gets a little hazy as to what the arrangement is, who owns what's the payout. You know, things need to be wrapped up in a reasonable manner. 15 days is a little aggressive.
Yeah.
You know, a proper estate rollover would be decent over a period of 6 months to a year would be
Correct.
best. Yeah.
Yeah.
Yeah, I guess what I liked about the presentation, both in June and now, Neeraj, is that, you know, a lot of the misunderstanding around insurance is that you have to die in order, and somebody else is going to get rich from it. But a lot of the techniques and the strategies that you have here, and a lot of stuff that Dave and I use in our business is, you know, that's not the case. You don't have to die to get rich on insurance. There's strategies inside of the insurance policy that allow for compounding your investment growth and doing it in a way that's tax efficient. So that was great. Any other questions there, Dave?
Yeah, we have a couple actually. You know, who owns the policy in a buy-sell agreement? Well, it's owned by the corporation.
Yeah, absolutely.
Because the payout has to go to the corporation first in order for it to be paid out tax-free to the beneficiary, and then, or sorry, paid out tax-free to the remaining shareholders so they can buy out the deceased shareholders.
Yeah. Correct.
So that one's pretty straightforward. Here's a really good question though. What are some important terms and conditions to include in a business partnership for a buy-sell agreement?
Okay, so I mean, we do have you know, sample agreements on the PPI website that you guys have access to. However, simplistically put, the most important thing that I tell clients is, you know, whether you have life in or not, the most important thing is that make sure that the buy-sell agreement forces one to buy and forces the other to sell. I see a lot of times where buy-sell agreements are written loosely where, oh yeah, there is an option to buy. And I think that's not a buy-sell agreement. That is basically, oh, sure, we'll do it if we feel like it, kind of a thing. So in my opinion, the most important clause that needs to be in a buy-sell agreement is that I pass away, my estate has to sell. You as a surviving shareholder has to buy. There can't be this, oh, first right of refusal and this and that. No, I mean, I would, if I was a partner, I would not agree to anything like that. I would basically agree to only 100%. So that is the most important in my opinion. Other than that, yes, of course, you know, try to fix some sort of, I mean, don't try to fix a dollar amount as such. Try to put a method or some sort of a process in terms of the valuation.
Yeah.
Right? A fixed buy sell where you are supposed to buy and you're supposed to sell. Valuation, that's number 2. Like the methodology that we use or who will be valuing, etc. Make sure that it is a third party, or some of the better ones that I see. These people, what they do is they have in the buy-sell agreement that they will value the business every 3 years, for example. So they will use an independent assessor to provide valuation. So those are some of the clauses that are put in the buy-sell agreement, that it is incumbent upon them to make sure that the business valuation is done every 3 years as such, because it gives the closest range as such, right? And obviously the third,
for example, we did a formula. So we have a formula, and if we decide at some point we don't like the formula, then we change it. But as every year goes by, the formula still works. So as long as the formula works.
Right, exactly. So if you have a formula, then whatever the fair market value, that's independent. But if you don't have a formula, then what you can do is you can actually keep on doing, you know, valuations on an ongoing basis, 3 years, 5, whatever you decide. So, but put something about valuation in there. And obviously the third part is the funding part. Like, don't just leave the funding. Where is the money going to come from? And how much? So when I talk about, you know, a definite buy and a definite sell, it has to have time period also. Just like we talk about SMART goals, for example, right? We talk about specific, measurable, etc. Time is one of them. So you need to put in the time required. You can't have the spouse saying, well, I want it done in 15, I want the check in 15 days. Right? As opposed to the surviving shareholder saying, oh, well, I'll give it to you. Here's a promissory note. I'll give it the money to you after 10 years as such. Yeah. So valuation, obviously time period, insurance, We've seen that if you agree to the fact that insurance is going to be the most tax effective, then why not put insurance in it? And when you put insurance in it, obviously talk about how it is going to be funded, and most importantly, how is the death benefit and capital dividend account being used. I've seen so many agreements where they talk about, yes, the buying out the shares using the death benefit, but they don't talk about the capital dividend account here. I've seen cases where the surviving shareholder says, no, I'm going to write a check to you for $5 million, which will be a taxable dividend, right? And the estate or the surviving, the spouse or the family member say, no, this was from the proceeds of the life insurance, so we need it to come out as a tax-free dividend. Yeah. Nothing was mentioned in the shareholder agreement. Go to the courts and try and interpret that, right? So those are some of the things that I would say. For sure, the definite buy and definite sell, valuation, and funding. Those are the three that I would say are non-negotiable.
Yeah, I think that's a very good answer and very good options for people. You did mention some sample USAs on the site. Is that are we allowed to share those on our site, or is that for internal use only?
Well, that's mainly for internal use. I mean, it is about when you're talking to a client, I mean, giving that, or this is material that needs to be used by qualified professionals. And I'm not saying that a client may not be able to interpret it, but obviously, if a buy-sell agreement needs to be drafted, it'll be drafted by XYZ lawyer, who already has a template as such. What we provide is what you can do is you can say to the lawyer, oh, these are some of the things that we want included in there.
Yeah,
that's about it. So that's the reason it is not for general consumption. It's not. That's why it is not available on the public website, because I mean it's legal jargon out there. Yeah. However, as and when it is necessary, you could use it to provide direction or guidance, or provide some bullet points to the lawyer that is actually drafting the buy-sell agreement on behalf of your clients.
Great. Well, it leads into the last question I think we'll be able to do here, but are there different types of buy-sell agreements, or more so, I guess, there's just different pieces you plug into an agreement?
Yeah, there are different types of buy-sell agreement depending upon what you're doing in terms of share, or whether you're redeeming shares or you're selling assets, etc. So that could be buy-sell. Buy-sell will be written up differently for those. Whether you have buy-sells between holding companies, whether you have cross-purchase, it's not like if the company is small enough, we only have 2 shareholders and that's about it. Whether you're doing a cross-purchase or anything like that. If you have a partnership as opposed to a corporation, the buy-sell for that would be different. Whether you're using, let's say, roll and redeem strategy, whether you're using a 50% solution as part of your planning, 100%, the buy-sell can be structured depending upon those. So there are various, and if you look on the website, Dave, on the secure website, you'll see that there are different types of buy-sell agreements depending upon what the underlying planning is.
Great. Really appreciate that. That's good.
That's great, Neeraj. In order to kind of stick within our time frame for our audience, we'd like to wrap it up now. So if there are other questions, you can always go through myself or through Dave, and we can always relay those questions over to Neeraj and get answers for you. Neeraj, we'd like to thank you very much for taking the time to chat with us today. PPI and yourself have been a great support to us at Tower Wealth. So thank you again for stepping up today and doing a presentation for us.
You're most welcome, Tyler. Thank you.
All right, guys. Everyone else take care, and we'll see you soon on the next one.